Good afternoon, this is Mike Bertelsen, the Bear Market Investor, the market update for the 15th of August 2011. We're here looking at the Volatility Index in the weekly time frame. We're going to be looking at the daily time frame after that, then have a look at the S&P 500 stock index, of course. Now, let's go ahead and have a look at our chart here. This is a chart that I've shown many times in the past in the videos that I was doing early on in this year. And of course I had a big break there in the middle where I was not producing any videos, but I want to show you what happened and how that worked out for us. Now let's have a look at the chart and what this actually means. Back in 2008, during the steepest part of the decline in the stock market, we established a higher in the Volatility Index. Similar to that, in 2010, we had another high there. I was simply able to connect this high and this high together to establish this declining area of resistance in the Volatility Index. Now have a look at this particular pattern right here. This pattern looks exactly identical to this pattern. We have this wedge formation here. We have this wedge formation here. Once we get past the middle part of this formation right here, we have kind of this sideways down movement. We have that sideways down movement right there. This is what's called a fractal. I discovered this a while ago, and that allowed me to form some opinions of what the market was likely going to do in the future and when probably to expect that. Now, I was also able to, and we'll look at the daily chart here to give you a better view, was apply the Fibonacci fan to this particular pattern. And what it came up with was some pretty astonishing results. As you can see, this blue line here pretty much identically matches this declining area of resistance in the Volatility Index. That is the 78.6% retracement on the Fibonacci fan. It's not a tool that a whole lot of people use, but it worked out perfectly for me in this particular scenario. Now let's go ahead and jump in to the daily time frame and just have one last look at this particular pattern right here. Now let's go ahead and jump into the daily time frame on the Volatility Index, and let's back up just a little bit here. As you can see, it looks very similar. Again, we have that sideways down movement. Again, this is a fractal formation. I was able to apply the Fibonacci fan to this wedge formation right here. Once we had a breakout of that, we tested the 38.2% retracement on the Fibonacci fan, had a false breakout attempt at that, came back down, had a successful breakout, back tested it, moved sideways, had an attempted breakout of the 61.8% on the Fibonacci fan, came back down, moved sideways, and then we had another breakout similar to what we had right here. Now I'm thinking this particular formation right here was the last of it, meaning this is actually a quarter the size in terms of a fractal that this formation was, which was of course half the size of the formation that preceded it. What we were expecting was that once we had a really strong and confirmed breakout of the Volatility Index, finding support of course at these particular areas, that we would have a strong spike in volatility. That is exactly what happened here in this particular case. We had that strong breakout in volatility in and around the time frame that I was specifically talking about. In fact, the market topped more or less in and around the same time frame that I was talking about it doing from a cycle standpoint, and what we were expecting for wave formation. Now, in any particular case, I wanted to show you how this actually looked. What to expect next is a little bit hard to say. We have to wait and see whether there are patterns that show up in the Volatility Index, but I wanted to show you just how important this chart was and why the Volatility Index is something that you should pay attention to. A lot of people, I remember looking on CNBC and hearing Kramer just ripping the volatility index, saying it's a worthless index. Now you can see that that's not the case. This was something that helped predict when the market was going to top and when we were going to see that surge in volatility. These declining areas of resistance, whether that be the 78.6% on the Fibonacci fan or this declining, longer-term declining area of resistance in the volatility index, showed us what we should expect, as well as the bottom here, or this long-term area of support in the volatility index. That helped show us what the time frame was that we were looking for, as well as breaking these particular patterns up into subdivisions so that we could see when they were likely to complete. I just thought that was very interesting. That's why I subdivided this out into particular time frames so that you could see just how the market works and how fractals form in the market. And fractals are part of the basis for Elliott wave theory, which is the type of technical analysis that I particularly enjoy and use in my videos. Now let's have a look at the S&P 500. Alright, we're looking at the monthly time frame of the S&P 500 stock index. I wanted to show you this as well. It wasn't something that I got a chance to really get into yesterday, but when I was talking about those particular long-term trend lines right here, what you can see is we had this touch back in 1997 right here, then again in 2002 and again in 2009, and we were able to establish this particular trend line right here. Now we're in a logarithmic scaling, which is percentage-based scaling right now. That exactly lines up right here. Okay, these two exactly line up. Now let's go ahead and have a look at arithmetic scaling. Now you can see this line begins to converge, where these are now identical to the slope of this. Literally, these are copy and paste. Okay, so in each particular case, we found support and resistance at each of those from a very long-term standpoint, and so that's why I believe that they're important. And again, as you can see here, we came up and we hit that boundary again that we found resistance at here and here, and you know, that is of course established all the way back to the top of this particular candlestick wick, all the way back in the 2000 peak in the S&P 500. Now let's go ahead and have a look at a shorter term time frame. We're going to switch this back to the logarithmic scaling, move into the daily chart. Now what I want to show you here is, again, focusing in on this third wave, or what I believe is a third wave. This being the first wave down, second wave up, third wave down. We're in a fourth wave correction. Now have a look at that particular blue line again. You see how that comes right across here. What I think we're probably doing is we're attempting to backtest that. We could even overshoot a little bit. Keep in mind, this is a very, very long-term trend line. But if I want to back up just a little bit, you see how we had a touch back there. We got essentially rejected off of that, came back down, moved sideways, eventually penetrated through that and went above it to come up and try to test these, this long-term resistance zone that I was pointing out before. Again, this is just different methods of scaling in long-term trend lines. And so we came up in there, and of course we got rejected out of that resistance zone, came up again. This is really what the end, or the fifth wave of C was. And since then, it looks like we are now in a new bear market, or a new phase of the bear market, the long-term bear market. Now what I think is probably likely to happen is we're just going to move ever so slightly higher, probably penetrate into this long-term trend line again before coming back down and completing a fifth wave. Now this is again just based on the intraday time frames, and what I'm expecting here in terms of the daily time frame wave structure. Let's have a look at our 30-minute chart. Apologize, I do have to adjust this just a little bit here. I don't know why this sometimes shows up with two of these. It's like this ghost line that sometimes shows up. In any case, you can see we actually had a back test of that right there. This is a very short-term back test. Did find resistance at that level, came back down. Now we're up in a corrective wave formation. This appears to be forming some sort of a wedge formation, probably because it's a C wave, meaning we actually had an A wave here, a B wave. We're working on a C wave, which is probably just about complete. We moved ever so slightly past that 38.2% retracement. So this falls in line with the projection that I had that we're probably going to see a high on Monday or Tuesday of this week. And that so far is looking like that's probably going to pan out. But of course, the market can do a whole lot of different things. I'm just telling you what I'm seeing here based on the information that's sitting in front of me, what we can expect. So I am expecting that we are probably going to see some sort of top, maybe even tomorrow morning on this particular chart, and that we should see that final fifth wave down put in, at which point then we're going to have that stronger snapback rally, which will bring us higher. Certainly it will bring us within the fourth wave of lesser degree, which is something that I talked about yesterday, which would be in this point range right here, between here and potentially here, if that's where it ends. But I'm guessing that we're going to probably end up with maybe a 61.8% retracement of the entire 5 waves down that we've gone through. That's usually more what I'm along the lines of what I would expect in a second wave. So again, that's putting the cart before the horse. Let's wait and see the wave formation as it completes. But so far, so good. Things seem to be more or less moving along as we would expect them to. In the daily time frame, though, one thing I want to point out here is sometimes you get these whipsaws. Basically a divergence setup, and I think that's what we're going to get. We're going to get a bullish divergence most likely in the MACD histogram, and that is essentially where we have this deeper tower here, which usually accompanies a third wave down, or it moves strongly, in this case to the downside, in a third wave down. Then we have it start moving up, then we put in a slightly higher low in the MACD histogram before coming back up again. And so when and if we see that fifth wave down occur, which takes out this prior low right here, we'll see a higher low in the MACD histogram before, of course, turning up. That's what's called a bullish divergence in the MACD histogram, and that is a setup for a rally in this particular case. So something to look forward to in the days and weeks to come here. Now, as far as how long that rally might occur, when it does, I'm not 100% certain. I have a guess that it's probably longer than a week, maybe up to a month. The market doesn't tend to generally move up as quickly as it moves down. However, we are in a very early stages of a strong downtrend, I believe, and we can see some pretty wild point swings, as we could see back here. I mean, just look at the wide range candlesticks that we have here, going all the way back down to in and around 1100 there, all the way up. We can see 1101 right there with a high that particular day of 1172.88. I mean, that is a huge candlestick here in the S&P 500. That's a huge and wild point swing, and we saw that day after day there. And so I'm expecting that we will probably see some of that even in the rally, that it will be a pretty sharp rally. I'm not sure exactly how long that's going to take to work itself out, but we'll see when we get to that point. So anyway, that's what I'm expecting, and hopefully I'll get to see you again here on this YouTube channel in a new video sometime soon. If not, I'll try to make one on the weekend. Have a great night, and I will see you guys later.